Hey, what's up? Trader Tim from EminiMind here, doing a trade recap slash market analysis video here in the ES. It's actually Friday, the 5th of April, and it was kind of a slow, choppy start to the week, and I use those cues early in the week to help me determine, how aggressive or active I want to be trading. So I didn't have any retracements on Monday, and then Tuesday and then I had one 1 minute uh, trade for a stop out, small stop out. And then Tuesday was a lot of the same as far as the price action and the way the market was trending. We had a lot of instances where, like here this morning, like this little doji inverted hammer, got a reaction down. But we didn't really break lows, even though it was a little bit of a trend lower. But it was more of like a lot of the stuff we saw this week was like these opposing tails where you have an inverted hammer and then a hammer, or you get a little break of a low and then turn back up. So one thing about the daily trend that we've seen is we've held higher highs and higher lows for this whole run up until yesterday. We had the big sell off, but earlier in the week we broke the swing low. And so using kind of the cues earlier in the week put me in a position to say, you know what, when by Wednesday, I was like, okay, I'm just gonna sit on my hands, and if there's a really good setup that comes, great. Otherwise, I'll take the 15 minute if it fires off, and that's about it. And then yesterday I had one small winner on the 1 minute chart. That was, I'll pull that up quick on the 1 minute here. 643, that was the lower high that lined up with the 50% retracement. So you can combine the 50% and the 1 minute in this way, where you're taking a short at a 50% short when an inverted hammer sets up, or a long at a 50% retracement long when a hammer sets up. So I took this one short and just trailed the swing highs on the way down. And Yesterday was the day we did get the big sell-off, but before we did, we kind of bounced uh, kind of later in the morning before selling off hard. So luckily, I did buy some puts on the day before, and obviously that has worked out really well. So slow or very few trades this week. Did have a couple of good 15 minutes, today being one, and Wednesday, both Wednesday, let's see, we'll just run through them here real quick. Wednesday, we'll go backwards. So today, first 15 minute, broke the high, got its 20 points. Yesterday, we broke to the downside, but before I could get the 20 points hit, we actually came up and pierced the high of the day. So that took me out for a smaller stop. Wednesday, got plus 20 very quickly. We were already in before the news announcement, and then bam, it popped. That got a 20-point move quick. Tuesday was one where we traded to, let's see, Tuesday. Nope, that's Monday. That's why. Tuesday, the 2nd. We traded to the downside, and then we just kind of fizzled out and ended up taking it off at the end of the day. Just kind of in this mid range, if you will. And then Monday was the one where we reversed. We actually went to the upside by just enough to get filled. And then I got stopped out, and then I took the opposing trade to the downside short, and then that got plus 20. So still a positive week, but a couple little stop outs in there as well. But going to the daily chart, so I mentioned the puts. I bought the puts here at the close because we came up to the halfway back short. And I always manage my put positions or my swing trade, I guess, like the hedging positions, the puts, swing trades as well, at the close of the day. And so it's really important to do that because when the candle's forming, like if you think about a 1 minute candle, well, at the time, like let's say 30 seconds into, let's go to this candle. Here we've got a nice hammer candle. Well, at the 30-second mark, it could look like a big red bar. So you need the candle to close to solidify. Is it a hammer? Is it a bearish bar? Is it a doji? And so that's why it's important to get really close to the close of the day before I put on my put position. And then managing the trade, I just kind of ignore what goes on during the day and just manage it at the close. So we did gap up yesterday. When we gap up at highs, it's a signal that it's kind of an exhaustive move. We also were kind of at a triple top up here. So you could kind of see that coming from a mile away to gap up and sell off. If we gap up and we're at lows, that could be the start of a new uptrend. So the context of where we gap is very important. And then the so we talked about the 1 minutes, the 15 minutes. On the daily chart itself, we do have this extension from highs to highs that was just extended up. We were down here, I believe it was, and then I had one extension drawn and then I extended it up from that same anchor point to the new highs. And so we did get that's kind of where we stopped yesterday. We got a little bit of a bounce, and we'll see if if we just kind of trade in the middle of or inside of yesterday's range today. Then I'll just continue to hold the puts into the next week and see if we can get another move lower. I did take some off yesterday at the close. When we get this big sell-off like this, that just helps lock in profit. If I do have a stock swing trade and we get a gap up, what I will do is put my stop above the first 15-minute bar. Like if it gaps against me, I'll put my stop outside of that first 15-minute bar. And if, let's say I'm long, and the stock gaps down. So rather than just like closing it out, if it gaps against me or against beyond my stop, using that first 15-minute bars low if you're long is really helpful. Or in the case of a short, which I don't tend to take a lot of shorts, mostly it's buying puts and then taking individual swing trading stock longs. But especially in this kind of tighter uptrend, I'll tend to have a handful of swing trades going. So if you like down here, the market pulled back and then we gapped up. So nothing to do as far as moving the stop is concerned. But let's say we were up here. Let's say I'm long and the market gaps down. Then wherever the first 15-minute low is, that's where you can put your stop as sort of a adjustment for whatever the gap was. And that way, if we gap down and continue down, you get out early in the morning. If it's initial reaction, we gap down and then we turn and go higher, then you don't have to just exit the trade early. So if you can do your best to manage your swing trades at the close, that's always the best, especially when it comes to buying puts, in part because you're going to be flat in the position, but also because like if you put on the position right at the close, there's not going to be much change that happens until the next day. But if you're futzing with it in the middle of the day, and then you go from like this big bearish bar middle of the day, and then you rally into the close, now all of a sudden you may have it may have looked bearish, and all of a sudden now at the close it's bullish. So let the bar close or get close to closing before you make any judgments about the trend or the trend breaking. Intraday, you can be a little bit more aggressive. So like if we break a 61.8 at any point intraday, regardless if the candle closes, I'm okay with taking that into my analysis. Whereas the larger time frames, the candle bars are much more important. So on a 1 minute chart, you do need the candle to close for it to be a hammer or an inverted hammer. But if we're looking at violating a 61.8 by 2 ticks, then it's important to look at the tail, and then like in this case, okay, we round down and we subtract 2 ticks. We are right at that kind of threshold of it's gone beyond the 61.8 by 2 ticks. So it's kind of right on the edge of failure, but still holding. We kind of had a double bottom here, double bottom this morning on the 50%, and then we've been going up since. So hope you had a great week, and we'll talk to you next week.